Two stocks. One sells energy drinks that are taking over store shelves. The other keeps human organs alive outside the body. Both have crushed earnings recently, but one of them might be the better buy right now. Welcome to the Money Mind. Today we are doing a deep dive into two stocks, Celsius Holdings, ticker C, and TransMedics Group, ticker TMDX. We are breaking down their recent earnings, forward guidance, analyst ratings, and key catalysts to help you decide if either one deserves a spot on your watch list. Let us start with Celsius. If you have walked into a gas station or gym lately, you have probably seen those bright orange and green cans everywhere. Celsius makes functional energy drinks. Think healthier alternatives to Monster and Red Bull, marketed toward fitness-minded consumers. The big story here is their partnership with PepsiCo. Pepsi now distributes Celsius, Alani Nu, and Rockstar Energy, making Celsius essentially Pepsi's energy drink captain in the United States. That distribution muscle has increased shelf space by over 25%, and convenience store placements are growing fast. The convenience channel makes up 60% of all energy drink sales, so this is a massive runway. Now the numbers. Celsius closed Friday, April 10th at $34.86. The 52-week range runs from a low of $26.09 to a high of $66.74. So the stock is sitting much closer to its lows right now. Market cap is around $11.5 billion. The PE ratio is 144, which sounds expensive, but context matters here. In Q4 2025, revenue exploded 117% year over year to $722 million. Earnings per share came in at 26 cents, beating estimates of 18 cents by over 41%. Gross margins dipped to 47.4% in Q4 due to integration costs from the Alani Nu and Rockstar acquisitions, but management expects margins to recover back to the low 50s by mid-2026. Operating margins are trending toward 21.5%. Catalysts going forward. Celsius is planning new limited-time flavors and expanding Alani Nu distribution, which already saw over 100% shelf space growth. Their Celsius Hydration line, launched in early 2025, moves them into zero-caffeine electrolyte powders, a totally new category for them. Analysts are bullish. 16 analysts have a strong buy consensus with an average price target around $66.50. That implies roughly 90% upside from where it trades today. Next earnings drop May 12th. The bear case, that PE ratio is still stretched, and if integration stumbles or energy drink competition heats up, this stock could stay range-bound. Let us look at TransMedics. This one is completely different. It is a medical device company that makes the organ care system, or OCS. Think of it like a portable life support machine for donor organs. Instead of packing a heart or lung on ice and racing to the hospital, the OCS keeps the organ warm, perfused, and functioning outside the body during transport. This dramatically increases the time window and the viability of transplant organs. TransMedics currently has FDA-cleared systems for hearts, lungs, and livers, and they are now expanding into kidneys. The financials are impressive. TMDX closed Friday, April 10th at $113.37. The 52-week range goes from $75.50 up to $156. Market cap sits around $3.7 billion. The PE ratio is about 55, much more reasonable than Celsius. In Q4 2025, TransMedics posted revenue of $160.8 million, up 32% year over year. Product revenue hit $100.4 million, up 34%, and service revenue reached $60.4 million, up 29%. For the full year 2025, total revenue was $605.5 million, a 37% jump. Net income in Q4 was $105.4 million, or $2.62 per share. That is serious profitability for a medtech company at this stage. On the catalyst front, TransMedics just received full FDA approval in February 2026 for their next-generation OCS Heart Enhanced trial. This trial aims to prove that their Gen 2 heart system is actually superior to traditional cold storage, not just equivalent, but better. If that data reads out well, it could be a game changer for adoption. They are also running the de novo lung trial, approved in January 2026. Management guided 2026 revenue between $727 and $757 million. That is 20 to 25% growth. 9 analysts rated a buy with an average price target of around $154, about 36% upside. The risk here is execution. Scaling a medical logistics operation is complex, and if trial results disappoint, the stock could pull back hard. So which looks stronger right now? Both stocks have momentum, but they are very different plays. Celsius is a consumer brand story, high growth, riding the PepsiCo distribution wave, but trading at a stretched valuation. TransMedics is a medtech innovator with a genuine competitive moat, strong profitability, and a more reasonable PE ratio. If you are looking for value with catalysts, TMDX arguably has the cleaner setup. If you want exposure to the energy drink boom and can stomach volatility, CELH has massive analyst upside baked in. Neither is a sure thing. Do your own research, know your risk tolerance, and never invest money you cannot afford to lose. This is not financial advice. If you found this helpful, hit subscribe and check out our other videos. I am the Money Mind. Let us keep building.